Hey guys, hope you're all doing well. Welcome to another episode of 21st Capital. Today we are going to talk about the very famous and infamous Bitcoin market cap multiplier that Bank of America had computed. This is basically, if you're not familiar with it, the idea is Bank of America and some of the discussion after the report indicated that every single dollar that flows into Bitcoin increases market cap by $118. So there is a multiplier on 118 for every dollar that comes into Bitcoin, and this has given people a lot of tools, a lot of ammo for huge prediction of the price, and saying, okay, if there is $100 million coming into the Bitcoin every day through the ETFs, okay, so the market cap could be going up by 100 times that, and that gives us the some extraordinary price predictions that people have come up with. In a summary, we're going to tell you why this is all wrong. So first of all, welcome, Z.
Hello, how are you doing?
Very good, thank you. We have a lot of interesting things today to talk about, and especially I love the sessions where we dispel some myth and destroy some very popular and common ideas that are just plain wrong. So the first thing I'll say is this is very popular. So many people, I just did some quick search and pulled up a few examples of good, well-meaning Bitcoiners citing this ratio. And again, the idea is $1 invested in Bitcoin brings in 118. And Samson Mao, for example. Oh, actually, Samson thinks it's too low. 118 should be 200x, and so on. It's just all over the place. But we're going to show you why this is this is overly optimistic. Now, I also found that James Chick has been talking about this, and he has been dispelling the myth. But we will offer our own analysis today on this one. So let's see. I'm gonna do this. First, we will talk about some of the fun, basically what the report was and what they said in it. Then we will quickly talk about some of the glaring errors that this report had in other places, not just the estimation of the multiplier. And then lastly, we'll talk about the issues with that specific multiplier. So, let's see if we want to be small over here. Yes. Okay. So the first thing, what was the report? Okay, in 2021, Bank of America came out with a report that showed. I think it's better if you're here. The report showed that basically looked at the relationship between the dollar amount of purchases necessary for 1% increase in price of Bitcoin. And they found that if they looked at the GBTC inflows, and they saw that every $93 million of inflow into GBTC increases Bitcoin price by 1%. And then they also looked at other things, gold and treasuries, and they saw that, okay, this ratio, the amount of money to do the same thing for gold is $2 billion, and more than that for treasuries. So, and then the whole focus of the paper or report was not about this. It was just a general analysis of Bitcoin. One little part of it was this analysis. And essentially through here, they weren't trying to say Bitcoin is so awesome because of this. In fact, they were trying to say Bitcoin is like too sensitive and too thin, and it's not a mature asset, and gold and treasuries are more reliable. So I went through the whole thing, I read it, and then we'll share some of the highlights of that with you. But other people took this number of 1% increase and converted it into a change in the market cap. And from there, they said, okay, so if 1%, if price goes up by 1% and market cap is X amount, 1% of it, so every $1 inflow gives us a few dollars increase in market cap. And then that gave us the famous 118 multiplier. Okay, so we will also say that that transition from Bank of America's 1% price increase to 118 market cap multiplier, that's also causing extra problems and extra errors. But before doing that, I just want to say, when I was reading this report, it was very clear that whoever did it was not very much familiar with Bitcoin. So they're making some weird comments. For example, when analyzing Bitcoin, they say Bitcoin remains limited by its complex settlement process, crypto mining, and can just handle 14,000 transactions per hour relative to Visa's stated 236 million transactions. So basically, they say Bitcoin is much inferior than Visa because it can't process all these transactions. Crazy error. They don't understand that Bitcoin operates in layers. Multiple higher layers of the system will be handling a lot more transactions, and also Visa doesn't handle same thing. Visa basically is the top of the layers. Bitcoin is the bottom of the monetary pyramid, so they're just not to be compared. And they also say, like other things they say, which is mind-boggling, they say no good reason to own Bitcoin unless the price goes up. Basically, first of all, this wording is crazy. Second, they say that Bitcoin has lost its ability to diversify an asset because it's just correlated with NASDAQ and all the others. So why do you even hold it? And then other things they say, they attack a little bit the ESG part of Bitcoin, CO2 emissions, and it would just get better if they talk about the carbon footprint per transaction and things like that. They also say things like CBDCs are a threat to Bitcoin, and Ethereum's DeFi is intriguing. So every little part of this is just reeking a noob that's just learning about Bitcoin, and they were asked to create a report on Bitcoin. What else is cool here? Yeah, I just won't bore you too much with the errors in the other side, but our focus in this analysis is the specific 118 multiplier. First thing, Bank of America, as far as I found, they haven't particularly talked about 118. They talked about the 1%. Okay, so and then some people converted into 118. But particularly looking at the analysis, the regression they did was they basically looked at the ETF inflows, which was at the time just GBTC, and then look at the price impact. So right now, right there, they made the worst mistake ever, because they said there is some money that comes to ETFs and the price goes up, and then let's look at the association. They simply missed. So basically that's the kind of regression they run. They saw there was a GBTC flow of 93 million and then 1% increase in price. But they missed everyone else that was buying in that time. In 2021, everyone was crazy buying GBTC Grayscale because of the carry trade that it was offering, and it was a crazy bull market with lots of liquidity, lots of inflation. Everyone and their grandmother were buying Bitcoin, and they have not included any of that. They're basically the assumption they made is all the money that comes into Bitcoin, it goes through GBTC. Can't be more further from the truth. The second problem they have is they don't understand, apparently, that you should take a long period of time, not just a bull market period where GBTC is active, because again, that period was very, very special, and a lot of other things was also happening. I will also say that they appear to have run a log linear model because they look at a linear dollar amount effect on a percentage change of the dependent variable. And the problem with that is the same amount of money does not lead to the same percentage of price improvement over time, especially Bitcoin's volatility goes down. So more and more money will be needed to move this price by the same amount. They also ignore this one. Essentially, when you stay with 1% as your fixed number, you're assuming that the same amount of money changes Bitcoin the same way all the time. Um, which is incorrect. Again, looking at Bitcoin, it's a log behavior, not log linear. It's a power law behavior. So the same amount of money that would have changed price by a significant amount in the early cycles, but as time goes by, the market matures, and uh, you need a lot more money to move the price by 1%. So that's the second error. And then just empirically, I have confirmed here that the volatility of Bitcoin has been going down. This chart shows the white line is volatility, and then I have a model on top of it that clearly shows Bitcoin is just getting less and less volatile. And even though the flows to it are just getting stronger and stronger, the price movement is a lot less. One of the best ways you can understand how wrong the multiplier is through MVRV and variations of it, right? MVRV looks at the total market cap that exists. It's a cumulative value. It's a cumulative look at all the money that has come to Bitcoin, uh, the real dollars that have come to the Bitcoin ecosystem versus the market cap. And you can see, for example, right now we are at 1.7, meaning if you look at every single dollar that has entered the system, the market cap is only 1.7 times that. It's not 118x, it's 1.7. However, as Z will skillfully mention, this is still an overall look. This is taking all the history into account. You can make it much better by looking at marginal impacts of MVRV. And then the last thing I'll mention is this is just a rookie mistake to take the 1% and convert it into a market cap, a linear amount of market cap. So basically, 1% increase in price would also mean 1%, almost 1% increase in market cap if you hold the supply fixed. But 1% increase in market cap means completely different things when Bitcoin is younger versus older. As market cap increases, that number changes all the time as well. You can't convert it into a linear dollar amount and stay with it over time. So it's basically taking an estimate from a nonlinear model and pretending that it's a linear model and continue with a dollar estimate. But Z will show you a lot better how to kind of do a much better job in estimating this multiplier. Okay, over to you, Z.
Sure. Let's see. Okay. I hope my screen is big enough. Do you see the numbers? I'll probably read the numbers anyway, but just want to make sure you read.
I think it would be a little too small for folks.
How
Better.
about now? Okay.
Yes.
So I just want to touch on that. I mean, to be fair about that Bank of America, I think what the writer meant was for every dollar entered to the futures ETF, what's the effect on the market cap? So I hope they corrected or they write it in a way that is more clear. I think they didn't mean every dollar into the whole ecosystem. It just meant every dollar into the future market. I mean, the future market derived from the ETFs. That's the effect. That's the ratio between that dollar would enter to the futures, ETF futures, and market cap. So they literally found a correlation between them or multiplier between these two metrics. But what we're really trying to find today here is the ratio between the market cap increase or decrease. I mean, the sensitivity of the market cap to every dollar entered to the whole ecosystem. That's what we're trying to do instead of solely focus on future market or looking at the every dollar into the spot ETFs. So if you want to look at the ratio and look at it fairly, you have to drive the denominator and numerator from the same portion of the system. If you want to look at the ratio between every dollar entered to the ETFs, you have to look at the market cap, share of market cap owned by the ETF, like IUM in the denominator. So you have to be careful when you're looking at the ratio. So today I'm trying to just walk through the method that we're going to use. Before I get to details, there is a very, very nice and well detailed article by Checkmate. He put it out in May 6th, and he talked about it very nice. And he actually measured in 4 or 5 different methods and gave you like a lower band and an upper band for all different methods. None of them is even close to what being claimed, 118. I'll try to explain the simpler method, but if you want to get into detail, I really recommend to read Checkmate's article. We put the link in the description of the YouTube video. You can go find it. But in order to show you why we can not only look at the dollar into the ETFs and find a multiplier, I just want to show you this chart is showing the entity adjusted volume on chain. What does that mean? What is the simpler way to describe it? It means how many coins are moving on chain per day, and it's smooth by 90 days. That's irrelevant, but I just want to say the number of coin moved per day that are economically meaningful. What we are trying to say is the total volume after filtering the coins that be moved from one wallet to other wallet owned by the same person. So we literally just look at the volume that is meaningful. On a daily basis, since August, we have around 100 to 120,000 coins moved per day. That is the number of coin moves on chain. And the number of coin net flow into ETFs is around, like when you look at the daily, is between 200 to 100 coins. So it's less than 1% if you look at the ratio. So less than 1% of all coin moving on chain is related to the ETFs. I have to emphasize again, by 1%, I mean 1% of all coins move, all transform or transactions that are economically meaningful. So that 1% is not going to be a good representative of the total inflow to the market. That's why we cannot use every dollar entered to the ETFs as a proxy to the total money flowing into the market. So what we can do is use another method to measure the capital inflow, because measuring the change in the market cap is really easy. You're reading the market cap from every data provider. You can just use that and find the change in the market cap easily. The challenge is how we can measure the change in the total capital or capital inflow, outflow over a certain amount of time. That's what we're trying to do. To address that challenge, we have done something. The on-chain data is built based upon this really, really famous metric is called realized cap. And we talked about it in almost every single episode of 21st Capital. But to just touch on it, I will say realized cap is the cumulative amount of dollar being injected to the market since day one. That's how we can describe it. If you want to just explain a little bit better, is let's say Sina has a coin that is 20,000, and he bought it 20,000 like 2 years ago, 3 years ago. Then today I go buy that coin of Sina on 70,000. So I have to come up with 50,000 to put on top of that. Like I have to pay 70,000, but I injected 50,000 to the market because his coin was already been paid for by 20,000. Now I'm paying 70,000. That extra 50,000 is what I've been injecting to the market. And if you look at this cumulatively, we can measure the realized cap.
It's basically the market's cost basis.
Exactly. And total money that being injected to the market, net flow injected to the market. Like as of today, if you look at the market cap, November 7th, actually it's for yesterday data, the market cap was 1 trillion and half. Like it was almost 1 trillion and half, but the realized cap was 661 billion. So when you look at this ratio, you are actually measuring the ratio between the market cap today and the cumulative dollar injected to the market, which gives you something around 1.7. That is the almost 2.27. That's today. If you look at today data, that multiplier is 2.27. But if you look at the cumulative moving average, which means throughout the history, let's look at what was the average value for this multiplier. It is around 1 point almost 7. So that means the multiplier, if you do moving average over that multiplier, it's around 1.7 for every dollar throughout history that was injected to the Bitcoin market. The market cap increased usually 1.7. But as you can see, this multiplier is moving and changing throughout its cycle. What does that mean? That means whenever the market is really deep and it is really hard to move the market cap, we need a lot more dollar to move the market cap. When the market is just in the bear market and the depth of market is really low, it is much easier to increase the market cap. So that's how it is changing. So if you look at it, like in the, for example, in the top of the 2021, this ratio was around, I mean, the moving average, 30 moving average was 3.4. That means for every dollar that was entering the market, that the market cap was moving $3.4. So that was the ratio if you look at cumulatively. But as you can see, it is changing. So what we can do, instead of looking at the cumulative change in market cap and cumulative change in realized cap, we can break this history to smaller rolling windows, smaller window, and measure this multiplier in smaller time periods. Like for example, we measure this multiplier for last 30 days, or we measure that multiplier for this month in bear market 2022. So that's what we're going to do. So let me open this chart. So in this chart, in every day of history, we looked at the change in market cap and then divided by the change in the realized cap over last 90 days. So whenever, like, let me just show you the result. Okay, for example, in November 2020, this ratio was showing 3.2. That means in November 2020, for every dollar that was injected to the market cap increased 3.3. But when we go, for example, in around March 2022, if you look at there, this ratio is above 25. That means in that particular range of, I mean, part of history, for last 90 days, for every dollar that was injected to the market cap increased by $25. So this ratio is dynamic. So if you want to be really fair, instead of reporting one single number, we have to look at the current data or recent data and measure it based on recent change in market cap and realized cap. So when you look at it, it is really dynamic. It is changing a lot. And to report that multiplier accurately, instead of giving one number, we should be calculating that ratio based on recent data. For example, today, if you want to look at today or yesterday, I think it's November 7 again, this ratio is around 7. What does that mean? I mean, in last 90 days, for every dollar into the market, I mean, realized cap increased by every dollar, the net flow of capital into the market increased the market cap by $7.5. So that's the ratio. But even if you look at these maximum numbers, like 20 something, and do like some sort of average, like a monthly average over this dynamic metric, the metric is, I mean, oscillating between 0 and really close to 0 and 25. We are way above, away from 118. So that number, the problem, like Sina pointed out, is just looking at the wrong share of the market. It's just literally looking at the futures market that was derived from ETFs and count that as a capital inflow, versus the way we just measure the capital inflow. It is using the realized cap, changing the realized cap. It is much more closer to the capital that is injected to the Bitcoin market.
So let me ask you a question.
Sure.
You said it moves from 0 to 25.
Not 0, almost 60 cents, for example. So sometimes the ratio is below 1. That means we injected $1 and the market cap increased by 60 cents. And it's both way. Sometimes the capital is outflowing and the market cap is decreasing. So we have sensitivity in both way. So we have to be careful what part of the cycle we're talking about.
Yeah. But then if you look at the distribution, let me just remove ourselves. If you look at the distribution, the high ones are a lot less common.
Exactly.
And seems like if you look at a median of that, we will be at exactly like at that green line that you have drawn. Seems like
Yeah.
that's a like much better number. What is that green line?
That green line is the cumulative mean, so it's not median, so it's around 6.
Okay, what about median?
I can, I think I can have, do we have a median? I can do a long-term median instead of, so let's say I do a median. Metric. Let's say do median. And to, let's say median 4 years, for example. 365.
This is where you on-chain guys do the magic.
Yeah.
And the formula.
Y6. So the median is around 4.5. See that multiple 5 is really repeated itself. So it's around 4.5, sometimes closer to 5. So that's the, like you said, median is more representative. I agree. We should just stick to the, instead of mean, we have to stick to median. So 4.5. If you look at the smaller window to measure that multiplier, I mean, between the change in the capital and change in the market cap, this is the number that I think is the closest to what we're trying. The people are trying to find out, like that, because I know they present the question in different ways, but all of them are looking at how much in dollar the market cap increases for every dollar injected into the Bitcoin ecosystem. So that's the ratio I would actually use, 4.5 to 5. But like Checkmate explained in his really nice detailed article, he used different methods. None of them are even close to that 20% of what they claim, 118. It's just way out of picture. So yeah, that's I would measure it. That's how I would measure the on-chain data.
Yeah. So the lesson learned is, guys, $1 does not suddenly turn into $118. Okay, enough of the hopium. And especially these are all momentary analysis, right? In a moment, in a short period of time, you can come up with some high numbers, as high as 25, but you can't extrapolate it into the future and say, okay, moving forward, I estimate so much dollars coming into the network, and then let's multiply by 118 or even 25 and extrapolate. The best you can do is maybe take the average or the median, which is somewhere from 4 to 6, right? 4.5 to 6.
Yeah.
And that's how much you can expect new incoming money to affect the market. Another thing I will say is ETF flows are not new money, in the sense that if you see $100 million entering the ETFs, not all of the money can be considered new, because BTFs bought it from someone else. That someone else just sold that much Bitcoin. So that person took money out of the network and the ETF brought in 100 million. So if you net it out, it's a smaller amount of inflow. So that's another thing to consider when you want to extrapolate into the future and just say, okay, let's assume ETFs are doing this. What will that do to the market share?
Exactly. Remember, I think it was in the episode 1 of our series of 21st Capital educational podcast we measured it. Like you said, if the one coin today was bought by BlackRock at 70,000, that doesn't mean they injected 70,000. If the cost basis of the whole supply is around 50,000, let's say all coins, like I have to see the realized price, how much is it, but let's say the cost basis of all coins that are out of BlackRock wallets, or the wallets that is attributed to BlackRock, the cost basis is 50,000. If BlackRock comes and buy that coin at 70,000, they're injecting 20,000, not 70,000. And we actually can measure that at the time that we're talking now, I mean, November 7th, let's say we measure every dollar that came to the Bitcoin ecosystem, I mean, the total capital injected to the Bitcoin ecosystem, and also we measure the total capital was injected by the ETFs. If you look at the ratio, is around 5.6%. So that means the whole money was injected since January when the ETFs were launched. Since then, only 5% of the capital injected to the Bitcoin ecosystem was attributed to the ETFs. So you cannot take that 5%.
So wait a second.
Yeah.
Does that mean out of all the ETF inflows that we see, only 5% of that actually is increasing the realized cap?
No. We're saying, like, let's say, since day one that the ETFs was started to work, like let's January 18, January 19. Since then, the total money that was injected, to the Bitcoin ecosystem, I mean, across all coins. We are not talking about only coins that are owned by the ETFs. It was around $236 billion is the real money injected to the Bitcoin ecosystem. Out of that 236 billion, around 13.5 billion was injected through the coins that the ETF were buying. And that's the real money. I'm not talking about the market cap. I'm talking about the real increase in the realized cap by ETFs, coins that ETFs buy. So when you look at the ratio, 5% of increase in realized cap was because of coins that the ETFs were buying. That's what I'm trying to say.
Got it. So only 5% of the actual money was coming through the ETFs.
Exactly.
So that's important, right? It has also been a very big question for us. How big are these ETFs compared to the rest of the market? So right now, just looking at the realized cap, they are adding only 5%. 95% of the rest is being added by other people who are buying the coin.
Exactly.
So that's another thing to keep in mind for perspective. So yeah, we can't easily take the absolute most optimistic number, which is not even possible. It's 5 times the actual calculation that the 5 times the maximum you calculated. But you can just take that and extrapolate for a long time into the future. And also, a lot of the estimates of the new money coming from the ETFs is overblown. So a lot of errors here. Now, the good thing that it's a great thing that we did this. So I'm going to take the link to this video and post to every single person who talks about this 118 multiplier moving forward. How about that?
That's a great idea.
All right. Thanks a lot for your time. This was a fantastic session, as always. Appreciate the wealth of knowledge that you bring to the show.
Oh, my pleasure. Let's wait for 100,000 per coin by December, hopefully.
Awesome.
Yeah.
All right. So we'll see you next week.
See you.